we figured even if you didn't really understand Bitcoin, you can explain its price move.
I notice more and more you pay in Bitcoin. I mean, people are saying it takes a lot of pressure off the dollar, and it's a great thing for our country.
I'm pretty constructive on Bitcoin and crypto because for the first time in all the years I've been researching crypto, the regulatory environment is actually really open to the idea of allowing the innovation that comes from Bitcoin and crypto and the decentralization and the trust.
And I was in Bitcoin then, not knowing if I was going to do it a third time.
I'm really not only bullish on Bitcoin, but I really like the idea of what's happening in crypto.
Today, we saw President Donald Trump not only warn Fed Chair Jerome Powell that he should resign, but he sends a message to all Bitcoin and crypto holders that US markets are about to see a massive shift. Financial analyst and Bitcoin bull Tom Lee breaks down what's really happening in the market and why it matters for Bitcoin. He recently shared his take on the current economic uncertainty. With tariffs and recession fears creating market volatility, Lee suggests that a major market rally is on the horizon. And that's where Bitcoin comes in. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Bitcoin's price currently sits just over $107,000, still up over 13% this year. He says the next phase of the crypto cycle is critical. The bottom line, Bitcoin's next big move depends on how this plays out. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first read about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. But banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer it.
Yeah, that's right. Now if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, I won't comment its valuation, but as a net income, or Tether is a better example because it's not public.
How do you trust those Tether people? You don't really know what's going on.
Well, that's where, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code.
Mm-hmm.
And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world.
Wow.
So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins. And financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah, so if you, again, model this out and utility, because remember, stablecoins, is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
You're a CNBC contributor, as am I, and you have these amazing moments where like you'll show up on Squawk Box and be like, the S&P 500 is going to go up, like 1 or 2% tomorrow, and then it does. How do you know these things?
It's a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck, in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
Statistically, it's still going to stay at 90% for accumulated history. So it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, let's say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And, like, for us this year, it was the high-yield market because high-yield spreads need to widen to like 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%, whereas the economists were saying it was 60, and we could tell by positioning and what stocks were selling off. The S&P down 25% has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. As the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And of course, everyone argued against it for logical reasons. They said, tariffs, they're not going to be solved for a year, the Fed's not your friend. The Fed is there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson.
Tom Lee challenges the conventional economic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem, selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Lee also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Tom Lee? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing?